You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The economy has held up this year despite numerous federal policy shocks and lingering fears of an imminent economic downturn. Manufacturers in particular have dealt with the rapidly shifting tariff policy environment, a surge in AI investment, and a stalled labor market. The ISM Manufacturing survey has displayed shaky business sentiment and shows what manufacturers are focused on as 2025 comes to a close. On today's episode, we talk with Sue Spence, chair of the Institute for Supply Management Manufacturing Business Survey Committee, about how manufacturers are incorporating tariff policies into their long-term decisions, the potential impacts of AI on manufacturing, and how the various sectors within manufacturing are faring heading into 2026. Stay tuned. Coming up soon, our interview with Sue Spence, but first, a quick market update. The September jobs report, published last week a month and a half late because of the government shutdown, showed payrolls grew by an unexpectedly strong 119,000 in the last month of the third quarter. The unemployment rate bumped up to 4.4%, and earnings growth was weak, however, so the data did little to change the minds of anyone on the FOMC. This was the last jobs report the Fed will see before its December 10th decision. Fed funds futures are currently pricing in expectations closer to a 25 basis point cut than for rates to remain unchanged, but a rate cut is far from a foregone conclusion. The publication of delayed government data releases for September continued into this week, with weak retail sales and benign producer price inflation on Tuesday. Nothing suggested a turning point in inflation or consumer spending, and the data measure the economy before the government shut down, so the bond market mostly dismissed the releases as overtly backward-looking. Consumer confidence kept deteriorating in November, according to the Conference Board, and the closely watched labor market differential component of the survey suggests the unemployment rate should keep rising in the fourth quarter. Treasury Secretary Scott Bessent said the second round of interviews for Fed Chair concluded this week. The process is down to 5 final candidates, and Bessent has said President Trump will announce his nomination before Christmas. Bloomberg News reported Kevin Hassett has emerged as the frontrunner to become chair next year when Chair Powell's term ends in May. The Treasury market displayed some bullish momentum over the last 2 weeks thanks to the jobs report and deteriorating confidence in the two major surveys. 10-year Treasury yields dipped below 4% briefly after the Kevin Hassett news, and all benchmark tenors are at the richer side of their respective ranges since the last FOMC meeting on October 29th. Commentary from Fed officials still points to a closely divided FOMC that nonetheless supports lowering the Fed funds rate to support the labor market, if not in December, then at upcoming meetings. That's all for the market update this time. Now our interview with Sue Spence. Our guest today is Sue Spence, chair of the Institute for Supply Management Manufacturing Business Survey Committee, or what many of us know as the ISM Manufacturing Survey. Sue, thanks for coming on the podcast.
Happy to be here, Will. Thanks for having me.
Our topic today is manufacturing, how federal policy changes and the uncertain economic landscape are shaping the outlook for the industry in 2026 and onward. Now, I would say the tariff policy environment has certainly settled down from the initial volatility we saw in April, but there's still a lingering risk that courts will overturn existing policies or the president will abruptly shift specific rates. So, Sue, do manufacturers feel tariff policy is set in stone enough that they can begin to make long-term investment decisions, or are they still in sort of a decision-making paralysis because the backdrop is too fluid to make those longer-term plans?
The second thing, for sure, they do not feel comfortable. Month over month, we have had the same kind of sentiment concerns. The comments of our hundreds and hundreds of survey takers every month is consumed with negative tariff talk. So what we're seeing is these companies are not making decisions, investing decisions, certainly not in a big way in reshoring. They're not making employment decisions. The amount of people that just hold on an opening, an employment opening and not fill is pretty amazing. It's the amount of the cost of goods sold that could fluctuate if the tariff sticks but it's just as bad for them is the fact that they're not sure what to expect month to month. So unfortunately, we have a weak manufacturing economy. Even if we have a little improvement month over month, these companies are not seeing new orders come in at a steady pace. So if your new orders are anemic, then your backlog and your production will follow, and they're not going to hire even if they have openings until they start to have assurances from their customers who are basically telling them, depending on the sector, we don't want to pay those huge prices, and so we're going to wait as long as we can.
One of the big motivations for these tariffs is to support domestic manufacturing production, to incentivize U.S. consumers and businesses to use U.S. suppliers instead of importing them from abroad. But I think very quickly, when the tariffs were implemented, we saw manufacturers start to complain about them. Part of that could be that, well, they have to import their own inputs that are more expensive. So even if they're a U.S. manufacturer, the cost of production is higher. So going off of what you just said, how much of this pessimism among manufacturers do you think are the policies themselves, and how much of it is the policy uncertainty, if it's possible to disentangle those two?
I think it is both, but my gut tells me that had we had a decision and stuck with it early on, maybe by now the companies would have figured out what they're doing. Are we going to absorb it because it's a one time and then we can pass along an increase? But they literally, I guess, can't make a decision that they're pretty certain is going to benefit their company financially. They have to protect their margin. That's, they're there to make money, of course. And I believe that it's more than just the initial bump up in price. In a lot of cases, input cost from US suppliers is more expensive, but I feel like there'd have been more willingness to possibly invest in US production for these suppliers if there was more certainty about it not changing in some cases, and certainly in the beginning. I think in June, when I did my first report, I went back and counted how many tariff announcements were there. And it was something like 36 since like the March timeframe. You can't operate, and you certainly can't make decisions that you're pretty sure are going to be beneficial. And again, the customers and the weakened demand has really dampened sentiment.
There have been some stories of manufacturers looking for domestic part suppliers after tariffs raise costs, and they realize that there aren't any pre existing producers of these parts in the US. A lot of government data can struggle to quickly account for businesses that are created, especially when these tariffs were only implemented 6 or 7 months ago. Have you seen much evidence of manufacturing startups in response to tariffs, or are they also in the same kind of web of uncertainty where, well, you're not going to start a business right now if you feel like the competitive landscape is going to change from these policies in the next few months?
Since I've done the report, I don't recall seeing one comment that decisions were made and that they were successfully able to reshore suppliers. It doesn't mean it hasn't happened. It's not been a comment that I've seen too frequently. There was one comment a few months ago, and I may have included it in my report, about neither the quarter point cut in interest rate, that was the first one a few months ago, nor the threat of tariffs is spurning us to reshore. It's still going to be more expensive to have it here. And by the way, we're not sure that that'll be a decision that isn't undone 3 weeks later because there's a new economic policy coming out from Washington.
So, do you think that uncertainty explains the behavior that we've seen so far this year from the tariff implementation? That manufacturers think, well, I'm not sure what's going to happen with these policies in the future, but for now, I might as well keep importing things like I used to and paying the tariffs because we have seen pretty high tariff revenues. They've certainly narrowed the Treasury budget deficit. But if people are paying the tariffs, that also means that they're not reshoring. So, does that story make sense?
It does, absolutely. Think about it, depending on the sector, it takes a whole lot longer than 6 months to make those decisions. I worked in aerospace for almost 30 years before I went on to FedEx for the last 10 of my career. That's a long lead time items. So think about had companies gone ahead and jumped and invested and maybe supported financially some US based suppliers. Now, here we are sitting awaiting a Supreme Court decision. I understand that could take till next summer to get, but if they're rolled back and they're undone, they've just made a really poor decision.
Yeah, I think on that note, it seems like most legal analysts that I read believe that if the Supreme Court decides that the president exceeded his authority under these emergency powers, well, there are other avenues to implement tariffs. And so there will just be this sense of uncertainty for who knows how long, maybe forever.
Yeah, and the number one thing I worry about is, and Tim Fiore, my predecessor, said it back in April or May when he did his last report. He said the manufacturing impacts is where we see it first, even though manufacturing employment is only 10% of the total US workforce. It takes about 7 or 8 months for it to start to trickle down. So my worry is that this is just going to continue. If we don't have a Supreme Court decision quickly, and if it really is, I read somewhere they have till the end of the term, I guess, which is next summer, it's just more uncertainty. Knowing that it's in the highest court of the land, really, I think people will be frozen. It's like, now I really don't want to don't want to go invest in reshoring something that might be permanently more expensive if it's going to get struck down anyway. So my biggest worry is that this indecision, because companies are really stuck between a rock and a hard place, as they say, is going to make this pain last longer. And I do worry about tipping towards stagflation in some cases. Who knows? Unemployment is still, I guess, relatively low, but the signs that we're seeing, so the numbers that are coming out, even if they're not from BLS sources, they're not showing positivity. So I do worry about that. And the best solution here is a quick decision, and a decision that can't be undone. So I presume the Supreme Court has the last say, but sometimes you kind of shrug your shoulders, and you're right, they can go back and lob a commodity at or a tariff at a commodity level. There's also other ways to have, I think, 150-day tariffs, but it would really, really be great if the big country deals could get settled, that the lawsuit could get settled, so these companies can get back to what they do best, which is try to make the product at the lowest possible cost for good quality.
Sometimes it's easy to talk about manufacturing as this one big generalized category, but in reality, the ISM surveys look at some sectors that are very different: transportation, petroleum, computer products. So, what sectors of manufacturing have had the best or worst experience adapting to tariffs this year? Are some of them more resilient and able to respond to this because their supply chains have domestic availability, or have they all really experienced more or less the same amount of difficulty?
If you look at the reports, we give in each of the sub-index areas, we give a 4-month look back, right? And if you look at that, you have some expanding industries. Let me give you a couple examples. Up until this month's report, transportation equipment tended to be on the low end, meaning if you look at 18 industries, they were contracting. And a lot of comments, especially around commercial vehicles, they get double whacked, right? They have the commodity tariffs like aluminum and steel, and then the country tariffs. So that has made them particularly vulnerable. Chemical products, I look at that very closely because chemical products go in virtually everything. We had them in the contrasting category, pretty deep contraction. GDP is the other thing that I look at. Out of 18 sections, you have 6 big categories that make up 72% of manufacturing GDP. That is food, beverage, and tobacco, transportation equipment, petroleum and coal, chemical products, machinery, and computer electronic products. So I pay a lot of attention to that. And the issue that we've had in the last several months since the tariff situation has gone on is a number of these big industries moving toward contraction. And the GDP numbers this month, if you read the report, 58% of all manufacturing GDP was in contraction and 41% in strong contraction, meaning an index of 45 or left. So I worry, it's not that the others aren't important, but as a percent of manufacturing GDP, they're just smaller. So chemical products is 20% of manufacturing GDP. Okay. So it is only 2% of total GDP, but we're talking about manufacturing. So when 20% of manufacturing GDP has been in contraction or strong contraction several times, it worries me. Is what does a chemical product go into? Just about everything, right? Petroleum, if you look back on the reports of categories or sectors that were expanding, that one has tended to be more toward the top versus the bottom. But you know what? Even this month, it was in strong contraction. So nobody's immune. And the pattern of comments are remarkably similar from sector to sector, including employment. Food and beverage tends to be pretty seasonal. So there are months when they're at the top of the list, meaning they have the strongest new order book, and then other months are at the bottom, right? So we try to take seasonality out of that. But the tariffs are hitting, maybe not equally, but they're hitting very impactfully across all these sectors. Again, if you think about it, everyone worries about their supplies. Everyone worries about the cost of the product and the effect on margin and margin erosion. And so the uncertainty and the chaos and the whiplash is consistent among the sectors.
On that note of GDP, it seems like we generally, in the economic landscape, have some pretty shaky optimism. I would even say pessimism. Job growth is really slow. There are all these federal policy shocks that companies are trying to manage. But in a parallel universe happening at the same time, we have these AI data centers, a lot of investment in them, and it's actually propelled economic growth in the second and third quarters quite a bit. With all of that focus on the AI data centers, do manufacturers believe that this is an exciting boon for demand? Is it just a temporary increase in production? How are these data centers factoring into manufacturers' ideas for the future?
I think, again, it depends on the sector. I think the building of the data centers and the equipment that's needed for that is really going to impact our computer and electronic products type of sector, which was in contraction this month, right? So, so they're not immune either. When I think of AI, and there are some people who say it's a bubble, it's coming, just like the dot-com bubble. I think Michael Burry said that, right? Big short guy. But I think about it with regard to how can the AI technology make production more efficient and decision making even in the back offices of these manufacturers. And I think normally you'd find some excitement there when reshoring is talked about, and even before AI became a pretty commonplace thing to talk about. I would think about, all right, if a new factory is being built in the US to manufacture a good, and if it's possible, those companies are going to tend toward, let's automate as much as possible and run them more efficiently with fewer people, because people can do higher order thinking than the machine can. And so I'm not certain that the manufacturing boom of jobs would follow a reshoring effort. There was a wonderful article, and it talked about the boom post World War II in this country and how getting back to the good old days is impossible, because that itself back then was an anomaly. It wasn't normal, right? And so getting, a clear understanding of what does remanufacturing in the US look like? It won't look like it did before. And the AI tools, if they're as good as people have said or purport that they are, then they're going to be a great productivity boost to these businesses. But you still need orders and backlog and production running. My worry also is that there won't be an investment as there normally would be because of all this chaos. So everything points to, let's get things settled and move on and let companies do what they do best.
The overall labor market, we've seen a lot of signs this year, and even starting last year, this idea of a low or no churn labor market. So companies are not hiring new workers very frequently, but they're also not letting them go. Some people explain this as just the scarring impacts from 2021 and 2022, where there are a lot of worker shortages, or maybe they are unsure what policies are going to be like in the future, and so they're holding on to these workers for now. Given the unique circumstances facing manufacturing right now, what is the
Mhm.
hiring environment like? Is there a difficulty finding the right workers? Are they finding new ways to substitute capital for labor? Or is there that same no churn that we're seeing in the rest of the economy?
I look at something called hiring versus workforce managed ratios. And we track this. It's basically based on comments in the employee questions on the survey. Back in 2024, early on, it was pretty even. For every person hiring, there was maybe 1 or 1.2 not hiring, but just kind of managing with what they have, or in some cases, laying off. It was very interesting to see how that started to turn around the time, let's see, in April of 2025. It was the last time it was even. For every person saying I'm hiring, there's one that says I'm not. That jumped to 1 to 1.4 in May, 1 to 3.2 in June, and it's just gone up since that. We're at 1 to 1. I'm sorry, 1 to 3.4 for every person doing the hiring and finally backfilling. There's three and a half round up to 4 that are just saying we're holding because the order flow is not coming. So it's all connected. If your order, if your new orders and especially your new export orders have dropped off the cliff, how are you going to make your margin? You're not going to support the business with the same level of staffing because you literally don't need it. Or even if you feel like you do need it, you can't afford to go ahead and do that backfill because what's next with the tariff policy that's going to impact orders. So I don't know if companies are doing the replacement with automation or AI. Frankly, that would require investing, which we are also seeing in comments that people are just holding on that as well. It's one reason why our panelists aren't getting real excited about interest rate cuts, because it's not going to do the thing that they need done to stabilize the business.
We saw household electricity prices accelerate starting over the summer, and these are excluded from what economists in the Fed look at, which is core inflation. But manufacturing is often described as an energy intensive process. So those electricity prices pass down to manufacturers, and then they have to decide whether to pass those costs on to consumer goods. So this year, have we seen manufacturers experience the same increase in their energy prices? And is it something they feel is worrisome that they'll have to pass on to their customers?
If that's happening, it doesn't make its way into the survey. I don't recall seeing a single comment, and I read 300 to 400 comments every month. There's a lot of them that's killing them. That is not what we're seeing. So it very well may be happening behind the scenes, but comparison to the price of the raw material inputs, it's not on their minds, at least on the minds of the people we talk to.
400 comments reading every month. That sounds like you get a lot of insight. I know that what's published on the public website, it usually stays to maybe 10 or 12. So you must have particular insights at what's going on. What would you say is a current trend in the ISM manufacturing survey that you think is important that may not be obvious to the average person? I know for a lot of us who are in financial markets, we're looking at the number past the decimal point of the headline index, maybe new orders, but there is so much rich anecdotal information taken in the survey. So what is something you think is being overlooked?
Because there's so many comments and we keep it to 10 because who wants to read 400? I do, but our consumers of the report don't. I feel like we're picking the 10 that are most representative. So typically I want to pick from these big 6 industries that make up 72% of manufacturing GDP, but also others as well. It's only a few months that I've done the report. Well, we're going on my 5th month. It is so consumed with this tariff talk. There's just not much else that's there. And these tariff comments show up in new orders, new export order comments, production, employment. It's really remarkable. And it's as much as of a single issue as I think has been seen in recent years. There's almost literally no other news. And I know that sounds a little far reaching, but having read them, I'm telling you, that is what we're seeing. There's nothing going on important that you're going to miss because it'll be in the report, right? What's curious to me, and I don't like to spend a lot of time overthinking it, is when we have a blip of input, like we had production go expansion for 1 month. And what I'll do is I'll search in the commissary, is there something that I'm missing that would explain this? And when I can't find anything, my conclusion is customer inventories are too low. And someone's ordered something and it's enough of a pattern across sectors that it's driven up that index. And sure enough, the next month it's right back down. So indeed a blip. So you're going to see the most important comments. And I do pay attention to anyone that's talking about interest rates because that's on people's mind, right? We have another decision for a rate cut by the Fed in December. But anytime I've seen an interest rate comment, it's not the thing that's going to help us, right? You go ahead and all means by do it, but it's not bringing orders back because the impact, as I said earlier, of the raw material prices, in some cases, it's 30 to 40% of what it costs to make a product, right? So the materials cost is what's driving it. And if you're in like the commercial vehicle industry and you're getting hit on aluminum and steel on top of components that you might need from a country like China or Europe, there's just no way to turn. And again, transportation equipment recently rebounded a little bit, but the comments that really catch my eye are that companies just aren't buying. They're just going to keep the fleet they got and just wait it out because they don't feel like they can pass it along. And that's another question I get. How much of it's passed along? Depends, right? I read something this morning that said 50 to 60%. And guess who's paying it? American citizens. We are paying this. No one else is, right? Countries may pay it. It gets passed along because who could absorb that company-wise?
Well, I think you answered the last question that I had planned, which is what manufacturers are worried most about right now. So I guess I'll add a different angle to it, which is it sounds like tariffs are top of mind, but do all of the other topics of uncertainty really, are they secondary to that? For example, it feels like we could be at a turning point in the labor market and the economy anytime right now. So are manufacturers worried that we could be on the precipice of a recession or inflation accelerating again? Or is it really just the policy uncertainty from tariffs that is top of mind for seemingly everyone?
Yeah, all those things are on people's minds. It just, as I said earlier, it seems like this is an unusual time because a single issue can affect so much. There's been a few comments about hard to find the right skilled technical workers, or there's one comment a few months ago that struck me about engineers. It's just like, we're having a hard time with this. You also hear that people are having a hard time finding jobs. Well, that second thing doesn't surprise me given the sentiment, 1 to 3.5, positive to negative comments about hiring. So it feels like it all flows, and try to take the political part about it out of it. If your raw materials are 40, 50% of your product and your most significant input is steel or aluminum, where you've got a tariff on the commodity as well as wherever it comes from. I do remember this in the pandemic. FedEx obviously buys a huge amount of commercial vehicles. And I remember every day one of my sourcing managers in my office saying, here's the data from, whoever the auto manufacturer was. Here's what's going on right now with steel or aluminum, because we had some really unusual things going on, and companies saying, we can't absorb it. You got to pay it. Or in some cases, we've got to walk away from our contract because we cannot lose that kind of money. So if that was going on then because of shortages and people couldn't come to work and produce. So it was temporary, it hurt. But this is something that goes on with the threat of what's next. So everything flows from there, and it's not like the other things aren't important, but the other things are affected by it. I just haven't seen a single issue like this. I always say I'm glad I'm retired now, not having to deal with this as a sourcing and purchasing executive. It's painful enough to read these comments and watch what everybody's going through. So hopefully things get more reasonable, decisions get made, and if it has to be by the Supreme Court, so be it. But hopefully it ends pretty quickly so these folks can start to get back to what they want to do, which is work and produce.
On that happy note, Sue Spence, thanks for coming on the podcast.
Thank you so much. Appreciate it.
That was Sue Spence, chair of the Institute for Supply Management Manufacturing Business Survey Committee. Sue really drives home the point that even though tariff policies have settled down from April volatility, manufacturers are still paralyzed by the uncertainty and cost increases posed by the current policy environment. Some of the most pessimistic analyst predictions from earlier this year about accelerating consumer inflation or a collapse in manufacturing have not come to fruition, but that could be deceptive calm before manufacturing firms decide to finally pass along these higher costs or start letting workers go. I think it's also important to note that firms are unlikely to feel a sense of finality anytime soon, no matter what the Supreme Court decides about the legality of this year's tariffs premised on emergency powers. The November ISMs will be released next week, along with private sector employment data from ADP and monthly vehicle sales. The University of Michigan's preliminary sentiment survey for December will also come out next week. The recency of those reports contrasts with the dated information presented by the September PCE that will be published next Friday. The Federal Reserve will announce its next policy decision on December 10th at its last meeting of the year. Heading into the pre-meeting communications blackout, officials are split between cutting rates and leaving policy unchanged. Chair Powell's press conference and the SEP will give investors a better sense for how the FOMC sees a future path of rates and the economy, and whether there's much consensus at all heading into 2026. The bond market is pricing in a slightly higher probability for a 25 basis point rate cut in December. The day before the Fed's policy announcement, the BLS will publish the October JOLTS. Investors have yet to see any monthly government data for the October labor market, and JOLTS could provide key clues about labor market tightness during the majority of the government shutdown. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. The views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.